Hamzei from lovely Southwest Florida. Do I just go in, David, or is it you going to give me?
Yeah, go ahead. I'm recording now, so you can just go ahead and start.
Okay. Welcome to this program. Dave is a good friend, and he asked me to give you guys a little update. I'm Fari Hamzei. My website is Hamzei Analytics. Just for reference, for last December, for 8 years in a row, I was ranked 1 by Time Digest. Here's our performance, and here's the ranking I'm talking about for 8 years in a row. So you can see what the different cycles that I've done. This year we've done okay, but you know it's a rolling 12 months, so it drops and goes up and down and so forth. I think our last trade was excellent. We had short. This is a daily. We had short a little bit earlier from here. We took a little bit of heat, but then you can see what we have done. Problem was very, very simple. This right there, right there. We're coming to new highs in advanced decline or not. Another one is let's do another DT trender basis. Where these are the new all-time highs for SPX, as you see, rising, NDX rising. Then you have transportation and the Russell do not. As a matter of fact, before we hit the peak, they're already pulling back. Here's how I look at it usually. I do a tracking pointer and put global. If I put this here, you can see what I'm talking about. Okay. We went 2 more days on new highs, create new highs, and I'm saying, here's the report. Actually more than that, about 5 days. And here was 1 more day. Okay. Here's about 5 days. So as you could see, and as a matter of fact, this Russell transportation has been an excellent indicator of showing something is off. If you go back in, let's see, here we go. This is the Dow. You could see where the peaks happened there. Versus this is October, October of 17 into October of 18 into 19. That was a huge signal. We're pounding the table. I run a website. It's advisory for hedge funds, high network people, active traders, so on and so forth. Some of the largest hedge funds are clients like Soros and Tiger Management. In some shape or form, we work a lot with SAC, we work with Russell, Frank Russell Company, and so on. Our work has been presented at SIBO, at Risk Management, so on and so forth. One second. So the part of our work is just to be able to analyze what I call the tea leaves, read the tea leaves, and that's what they pay us for. So let's start doing that quickly, see what we look for. Our first chart, and by the way, any of you guys will do run something on this, we're welcome to. Let you come in later on. Don't subscribe to anything, just contact Dave and we'll figure something out for you guys. But it's been a tremendous week, very busy, but here's what we're looking at. We do send updates on Saturday and Sunday, give you some charts. I want to go over those charts. And then we set up a trade on the option side on Monday, and then we give you probably a window of an hour before we pull the trigger and say go in. All right. The purpose is to put your excess cash to work on an index with low volatility in a defined risk, which is long call spreads or short call or long put spreads. We do not short anything there. Okay, so these are for IRAs or approved, but we got a trade. Our first chart that we look at is the timer chart. This is one of the earliest charts I put together several years ago. It probably goes back, I think, 2003, 2004. Always on transition, but over time we've improved it. We've added features to it as we saw pertinent. One of the key things I look at is the up and down volume ratio. remember this is upside down to up volume ratio because I want to inverse. I want to see how this peak there was. So we may be getting long here. This is the signal I was looking for, but it's a little bit early. I would expect another week or two. What signal I'm talking about? We had a low here on Monday. Low here on Monday at -1 sigma. We go to -2 sigma and hit the 50 bar. And look at what kind of a down to up volume ratio we have. It's almost there. Let's see, what was this? That was what was this value? Well, that ratio. Believe me, you gotta look so detailed. Huh? Come on. Hold on. One second. I'm not trying to do that. Let's see what this value was. So that was about 834, maybe. Yeah, that was about 834. We're slightly below that. Technically qualifies, just like if you've done any Wyckoff method stuff, lower price, lower sigma level, okay? Slightly better reading. Lower reading here because it's inverted. Remember, it's inverted. So 8.34 went 8.14. Now, typically I get this a little bit wider. You know, this is a little bit wider time frame there. And it's a little bit more pronounced. This is too close to each other. But it still qualifies as over 5. 5 to 1. That means this was at 8.34, let's take 8. 8 out of 10 shares traded were to the downside. Okay. That's a pretty strong day. We have seen 99 to 1 once. But anything above 10 is a significant day. So that's what we look for. If you go back, usually those set up the bottoms. Now, bottoming process at times could be a V. Sometimes it's not. The top is always a process. It takes time to create a top. Bottom is more of a V type. You sharp down, sharp up. Why? Fear and greed. Remember, markets make money to push the low hand, this weak hands out. At the bottom, you're getting rid of the weak longs. At the top, you're getting rid of the weak shorts. That's just how market momentum comes in. You got to understand the order flow. That's how pressure is put in. It's for nobody wants to buy or sell by force. You get forced to. You know, maybe it's leverage, maybe bad timing of the cash flow needs, what have you. They all get combined with, for example, fear comes in. What we have impeachment and or the coronavirus. It added. Of course, I think the FP was helpful. I mean, just to the downside, the bad news there. While on the counterweighting, you have Apple and Amazon. So earnings season is usually a little bit volatile. That's good to watch. All right. Breadth Trust is at 41.66. Our threshold is 40. These thresholds are established over tons of years to see what to look for. This is McMillan. I was a student of Sherman Miriam McMillan, who created this. They were in my user group, and so we always had Sherman get up and give us an update in Los Angeles. And we're getting also set up for a divergence. You see a low pressure there and a low pressure there. Per his instructions to me, it says don't look at anything below 150. Don't look at anything above -150 or below +150. Most documentations talk about 100 and 100, but really, based on his research, it's a 150 on the top and -150 on the bottom. We're putting in 179. Okay, so we're getting stuff there. Now, remember, this you need to refresh after the data settles. You want the settlement data because of the plans. Moving forward, let's go to canaries. I've always had this opinion, and of course, others have started copying it, including CNBC. That's nothing new. The way to look at the market is really look at transportation and bustle. Why? Transportation is that at this point, especially at this point where we are in this economy, is uber crucial. You can see what Amazon is doing, for example. You can see what's happening with the brick and mortars who are also trying to be online, and you can see the pressures that you see on the coal transport, oil transport, by rail. You can see pressures on FedEx. Good news and bad news on both sides. So they are becoming a bigger player. Why? As we become more online, our time gets compressed, we see the deliveries. And even to get the deliveries itself, You need parts, component deliveries to a factory who make the finished part, then it goes to a warehousing, goes to a distribution center like Amazon, and then you buy it from them again back to deliveries. So the health of the economy, in my opinion, is predicted on a discounted method over how the transportation charts look like. I have not seen anything recent where we kept on making highs and transportation stopped. Just when transportation was lagging, was not supportive, was not in concert with the new highs, the market was a house of cards. It'll come back to reality, and we're beginning to see that now. How far will we go? That's another chart we got to go detrender. We'll look at the difference between the price, okay, and where the 50 bar is for this chart, and 200 bars for this chart. We do it for all four key indices. Granted that SPX and the NDX have a 99 plus correlation most times. So given that they share so many names. But again, transportation is crucial to watch. Look, this is all-time high. I plot all-time highs constantly to see where we are, and you can see the divergence. This divergence is alarming. We have to pay attention. Now, where the bottom is on the other side of this. If you go back and say, okay, how do we make the bottoms? You can see how the bottoms were made. So we're just starting a journey here. How far will we go? I don't know. Nobody knows. It's tea leaves. You read it one day at a time. On the closing basis, I look at these charts one day at a time. So, all right, let's go to one of our proprietary charts called SP1 Momo. These two indicators were put together for a fairly large hedge fund in New York based on a visit I had on a flight back from New York. I was in LA at the time. And these numbers are gibberish by design. It doesn't matter what they look, it's the shape. It has to do with a modified advanced decline calculation on the SPX itself, not all of Dow Jones. I mean, not all of Dow Jones Industrial, but the 500 names. But this is modified to a filter. And then we make a shorter version of it to be able to set up some sort of a divergence. You could see new high in SP1, right? New high. Look at that. We barely made we barely made anything above it. If you go further back, actually, probably more pronounced. If you look at it here from this high to that high, look, we're lower, and we're heading lower. So around -10, we'll probably see a sell-off end, and you would see a basing to start. Historically, it's done that. The other thing you want to look at, which we'll be pounding the table, we do webinars constantly, are free, that open, market timing, probably once a month, twice a month on the average. We talked about 52 weeks high and lows. Matter of fact, last webinar, which was not PMT, was not market timing, was a totally different issue. Was had to do with AQ futures. A couple of people locked on this because we were talking about this was last week, middle of everything going crazy. So there were a couple of questions on PMT. We entertained that, not a problem. We came back and said, okay, take a look at what we see here. This is 52 weeks high and lows. Look how they alternate. It's crucial. Okay. As we build, as we build into a momentum position of everything working fine, hunky dory, Remember, this is the weekly data. You can go back by that. If we get a high reading of about 150 and about 160 area, watch out. It's just too good to be true. It's priced for perfection. We're getting ready to fall off the cliff, possibly. To some extent, not a huge cliff. I'm not trying to say we have a huge drop, but to some extent, this is what we have coming down. Okay. And then what happens below? The 52 weeks low are very low reading. As they reach up, the bottom is there. Okay. So as these go up, the top is coming because it becomes unsustainable. It's just energy. It's like a fighter jet that all of a sudden wants to go vertical. You can only go so much. It's really exceptional with few aircrafts. So you can speed up and ramp up, but at some point you don't have that weight to trust ratio to get you over the hump and go straight up like a missile. So you've got to fall back. Well, that's what happens with the market. It just gets at the point where you're running out of buyers and just not enough energy and inertia to keep the height you're reaching, and it's going to fall back. And that's typical. Same thing happens on the bottoms. Look where we are. As this thing, the new highs go crazy, these are 52 weeks lows on S&P. Again, 500 names only. I'm not looking at all the garbage that's in NYC. I was a student of Burton Malkiel at Princeton. He was my first econ class teacher, professor. He's the one who did the indexing. He sat on the board of Vanguard. And so I remember this. He's been there. He's up there in age. Very sharp cookie. It was head of the Council of Economic Advisor at the White House and head of the Princeton Economics Department. One of the things he taught us was understand the construct of what you're looking at, especially the index. So when we go into choosing what represents the market, what should we be looking at and why, make sure you dig in and understand the construct. Just don't take it because others already got it. That doesn't mean anything. Come in with a clean piece of paper, clear mind, and look what's inside of it to understand the construct. The construct doesn't work. For example, it's arithmetic weighted, not cap weighted. It's not going to work. We really have to look at it because we don't have as many stocks anymore. Keep that in mind. And we have a lot more money. So a lot more money is chasing a small number of stocks. If you don't understand the construct of the index, for example, I never look at Dow Jones Industrial. To me, it's bogus. My index look at is SPX and NDX, boom, all the time. There you go. Let's see. So here we have those. Here's the two timing model, the mechanical. This is a weekly, so it's a very slow process, and this usually overrules. This is the force majeure, if you will, in the sense that large monies trade weekly signals because cost of transactions in and out, and in certain times, if you held on, as Jesse Livermore said, he said, I made more money out of those held on rather than just quick in and outs. So that was probably the first day trader ever out there. But less is so. If you look here, here's a look. Long term, weekly, we got a buy signal on March 8th of last year, and still holding. It does allow you a little bit of shake. It is mechanical. It has nothing to do with my view of things. It's an input to my view. When I write the PMT, I go through 15 charts or so. I post 6 to 8 of them. I think they're relevant. And then I do a recap at the end. Nothing here should be left just to mechanical systems. Mechanical systems over a long period of time, they have not traded very well. They beat. I mean, the returns are oscillate near your moving averages, nothing greater, because just they're mechanical, they're a little bit delayed. You have to enhance them by additional tools like CI type, zero lag, if you will, and also the reading that we read from reading the tea leaves of the peaks and valleys. Okay, so on the various indices that we plot or modification, algorithms. So, those two are long. This is long. We just got a short here, not a bad short there. 724 on Momo. I sometimes put this on Twitter. A lot of guys who followed me want to know or they ask, "Hey, Fari, what's the Momo doing today?" Well, I read it to them. What's the value and the direction? 724 and pushing to the downside. I think as we said last Monday, this is a dead cat bounce coming. Short-term wise, yes. We've got something here. I think this is going to be a bounce until the next leg comes in. We also did something on the coronavirus that is not easy. This is what we're facing. And given that it's happening in China, who knows how much real intervention we're going to get. Drips may come, and this could drag us down. So that's what we've got to look at. All right. So I'll make a decision tomorrow night. By tomorrow night, do we want to jump back on and get long? Probably, but not 100% convinced. So we still may have some more leakage to go. Why? Sometimes it's not easier to get more flushed out there. We're at 8. You get over 10, 12, then you have a good flush there. If I go back here, you can still see this was a nice flush there. What was this reading there? 20. You get to 20, you have a nice flush. Now you can go in with size on a game long. But we may play a small trade there. All right, let's go to a skew. A skew is a tail risk of to the downside of put activity of SPX itself. Okay, so you have a bell curve. It's this side of the bell curve. It's a tail risk. It's the index that was put together in kind of a haste. In 2008, 2009, I know head of Citadel let me know. Head of volatility trading for Citadel. Yeah, he's much smarter than this guy. Is much smarter than Kenny. Yeah, Ken Griffin. Yeah, this guy is amazing, and now this guy's on fun. When this came out, I got a note from him saying, "Hey, have you looked at this?" I said, "Hey, I'm not gonna mention his name. He's the Indian gentleman." I said, listen, I'm just not a poor dumb immigrant. I'm not like you. He was laughing his head off. He goes, no, I want to know what you think. I said, well, its efficacy will be shown over time. We just don't know. Okay. The design limits are 100 to 150. You can already see we've never gone to 100. This is the lowest that it's ever had. It's all-time low. This is all-time high. It blew through the numbers, 159. And then what I did is I laid on that Sigma channels. All my life, the work I've done has to do with Sigma channels, which are the superset of Bollinger Bands. It goes back, I call it Sigma because I want to give it a generic name. This is statistics. It goes back to the Ottoman Empire, 400 years ago. John, good friend of mine, he endorsed my book, you can see that, uses this line, and this line, and the central line. But I believe my thesis is there's more to that. And he and I have discussed that. Because I'm Persian. I lived in LA by the beach, and he lived down the street from me on the beach. He loved the kebabs and scotch. So we had a common heavy-duty interest. Now we would go to these nice places by the beach and order some shish kebabs and find scotch and talk markets. How else can you get better? And I learned a lot from him. He's one of my mentors. So we went back and forth on this. I mean, in this area, remember, John has really done one area, which is heavy duty, this volatility stuff, and then recently he's done some stuff on volume indicators. Got both of his books, he's a friend, we talk every so often, we email, but I'm no John Bollinger, I'm going to say that, he's up there. But anyhow, one day by mistake, again, by the beach, I was tired, I was working on some charts, and there was fresh air coming in from the beach, and I was sitting there, and I said, you know what? I'm done. I did not exit the page. I left. Well, so I'll come in the morning and see what's going on. I come back in the morning, and I'm not that tired anymore. I look at it, the lines don't make sense. I'm seeing this line all of a sudden plotted. Remember, John Bollinger doesn't do all these lines. He does +2 and -2, +0 line. Okay. Well, all of a sudden, and this was seeing the trade in the channel. See how I trade between this channel and that channel? So I started building these rules. If you're +1 to +2, that means you have to plot all of them. On the way up, and you don't, you cross over. You cross over 0 line, and you jump into +1, +2, you're good to go for a while. Okay, here you have to exit out, of course, because you violated the 0 line. But you can build a reasonably easy mechanical system. Can you code it? Probably. It depends on what your coding abilities are. I haven't, but I presume it's not that difficult. Same thing on the downside. You get +1, +2. I'm saying -1 and -2. Look what happens. It stays in that realm, just bleeds to death. Okay. So what I did was, because of that background, I put Sigma channels over anything I look at. If you look at all the charts I've shown you guys, there's just Sigma channels everywhere. Why? These are naturally occurring vibrations in nature. We as human beings operate that way in our brains, in our fear, in our greed, in our love, in our hate. It just goes on. It's been going on for the last, I don't know, 6,000, 7,000 years of recorded history. So as it peaks, we want to see where we are. Look where it peaked on 4 sigma. That's 4 sigma, the dash line. 1, 2, 3, 4. That's 4 standard deviation of where it was in and pulls back. To me, that was also a problem. If you go back to the webinar back then, you'll see that I brought that up, saying, guys, this is alarming. All of a sudden, look how quiet this has been. Not just its value, but also its sigma channel. I usually train my brain now since I figured this out. Which would have been probably 2003, 2004. I mean, right at the beginning of the second Gulf War. I came up with looking at it that way, including volatility, by the way. I also look at volatility. I don't get that. But anyhow, so I look at where we are in terms of value, in terms of high and lows. Also look at against itself, what's its vibration. And when you hit these peaks, usually pull back. Or the downside too. If you get too far down, it's not pull back. Now, we did not go too far on the downside. I realized that. Remember, the bias is to the upside of this indicator. Why? It's the tail risk of the put activity. Okay. As a matter of fact, if we go to let me quickly go into something that you guys may want to take a look at. That we post as a reminder in our system. Then here, every issue. This is our market timing issue. Everything we do is recorded there. You also have a archive. You can go back to any issue, you can find all the charts, everything. We're very, as one of the guys in Chicago trading circles used to call me, Fari's middle name is transparency. But we show everything. Good, bad, and ugly is there. But here's what I want to show you. We put this in there. Okay. This came from white paper on SQ. Okay. You guys who are very good, happy with options and understanding about, can get the picture that the a vol or volatility data tells you. Then you want to probably read this paper. I'll look it up again. I'll send it to David for you guys. But the white paper they published, it gives you the limits, 100 to 150, around 150, and it shows what the risks are. So if you come back here, we're at 135 now. At 135, we have an 11% chance of going to 2 standard deviation. Okay? And we're already there. That's gone away. Okay. And let's see. And 2% chance of going to 3 standard deviation, which is here. Okay. And again, this is SPX. Now, let's see where it was here. This was up there, was 145. So let's go back to the same table. Okay. 145, you see the chance? A 15% chance of pulling back to 2 sigma. And guess what? It took it. It took it. That was a sigma. It took it. It went there. So I do an SQ. Now, SQ is reported at the end of the day. So you have to wait for a data to settle. There's no intraday value. Why? Because you have to compute that tail risk of what the big, and this is big boys only. SPX options are not for mom and pops. Yeah, they're too expensive. So the very, very large institutions play that realm. And so that's a good indication of what the big boys are trying to do. Let's move on. I do look at VIX futures. I do a VIX spread constantly. As a matter of fact, back to here again. If you guys like options, like I do, because I was a student of, by the way, you can read my background. You read this, I was a student of all these guys. These guys did what Black-Scholes started, these guys finished, and I was their student. Okay, not a tribute. Let's go back here. Let's see. What was I doing here? I forgot for a moment. Oh, yeah. Sorry. Okay, so if you go to the home page, you want to read this. You see the master sessions. I was the first master session when they started at CIVO, second person who was at guest faculty. Some of my blog posts are there. I do not post a lot, but what do you call it? This one, according to the logs, most read blog post of any post on CIVO. And that's exactly what this is. We're talking about how you pick the low. It's a tool to picking bottoms of S&P 500 index. That's what this chart is. What do we look for? A high reading, high spike. Look at that. And this spike needs to get to Murray. Hold on, Murray. Let's see. We got to make sure you're on it. No, that's right. That's February and May, right? So that's a G. Yeah, and that's a K. Fine. Okay, you're fine. Yeah, no. Yeah, K, J. Yeah, we're long G, short K. Okay, that's a 3-month spread. Right? Yeah, so if you look at that, why are we so low here? Something is off again. Wait a second. Hold on. 1830. Yeah, 120. Is this? No, that's what I'm saying. This is wrong. Yeah, hold on. Yeah, there you go. There you go. Sorry. I'm thinking that chart doesn't look right. Plus, we're not there. There we go. Okay. The bottom is it. It went to positive. When the reading is gets to positive, you're almost there, close to. The reading there at the very low there was what's this one? Let's see. 0.9, so +1. We hit +1 there. If you go back here, you'll see the tops are near 2 or 3. I usually like more comfortable with negative. -2, 3 area. That roll there, that's the top. So it's a very, and it's I think $1,000 size is 1,000 to 1 for VIX futures. So it's a favorite of big guns. Again, we're trying to see how they're hedging their positions, how they view volatility, how they move around. So during the day, I look at it, and sure enough, I put a Sigma challenge on that. You give me an asset, I'll put a Sigma challenge on it. Yeah, my ex-girlfriend used to say that. So, one of these days, you're going to put a Sigma challenge on me too. Said, hold on. Yeah. Tall blonde. Yeah, I don't know. We'll see. And Sigma challenge, they may not mix well. Anyhow, the other one that we look at, so this is one Sigma. It's called VX futures. The other one is our SP2. SP2 is a proprietary indicator. I've not ever given the code out or given the encrypted code out for members to use. We only show it in our charts. We discuss it. I would say this. It does not have any price in it. Okay? Has nothing to do with the price of SPX. Okay? But it's got some modification, a mix of internals of SPX. Remember, SPX is the most asset with largest number of internals. Why? Because it's highly valued. It's 80% of US equities. When you make the market, okay, and you come and say, I'm calling it. You know, as they say in the Navy, call the ball as you come to landing on a carrier. I've involved with that stuff before. Here's what we've done. This is S&P. We have beat S&P by 25% in 5 years. So we have beat by 5% a year compounded. Now this was a car accident. That was a disaster. We came back again with a roar. But if you look at this and say, of course, this is as of 27, you can see what we are now. Man, just killed it. But I will update that. Sorry, this was updated as of Monday. So when you call that, you're making a bet on the 80% of US equities. Okay, very big ship, doesn't move around that easily. But when it does, you're not gonna forget. Now you have that vast decline, you have trend, you have the up and down volume, you have the skew, you have the VIX futures. I mean, this is the most index for having internals. So we feed some of that internal in there. Originally this code was written on a very primitive machine in 1995, 96 maybe, something like that time frame. And as I was in LA, and then over time, slightly, very slightly, most of my stuff, I mean, my CI has been out there 20 years. No need to touch it. If the indicator is good, it takes a while to get there. But when the indicator is good, you're good. Our OTF took 5 years to write. I'm not saying I drop everything and sat there writing for 5 years. No. I have a life. I live in Chicago a lot. Taught at CBO and CME. Good life, you know. Very nice girlfriend. We hang out. We had a good time. My cousin had a boat. But when you get some free time and you have a clear mind, you sit down and say, okay, where did I left off? OTF took 4 years almost to finish the code. And then about a year to introduce it. You apply it from pure design into applied environment, somebody could use it and consistently make money on it, both in the ES and NQ. So that was a little tip. This has been out there since, again, 95, 96, maybe 97, that era. And basically it's an oscillator with two thresholds, 75 and 25. Below 25, I want to buy. If I can get this, I'll go crazy. I love this. 2 moves below. This is very good. This is incredible. Look at what it did. Lower price, yeah, but they were not much below. You at this point you mortgage the wife, the kids, the second home, the boat, the dog, and you go buy long. Where it goes. You wait. I sit down and wait for this signal. They get at the end of the day. Yeah, during the day you get it, but it's not reliable. Here's another one. Look at that reading was. It was 8.49. Now, we get into a mess there, okay? But usually when you have a lot of oscillations, end results is up, okay? But starting following with a sharp drop. This is a flush. This got rid of the weak longs. So what is the moral of the story? Don't trade big money. Trade small amount of your account. Have some buffer. Experience will teach you. I mean, listen, I've been humbled. I was a cowboy, and yeah, I love a few accounts. So, and the pain teaches you. You're not going to get experience in a book or an MBA or at Princeton or anything. It's pain. You got to go through pain and say, what? Yeah, what the blank? What do they do here now? So, all that. And also throw your books out the window. Right? That's what I did in Chicago. All the stuff I had, for what? They didn't teach me anything. Yeah. It's a lot of the common sense, some of the risk management, and clever indicators, no question, and then holding resolute, okay, so that you stay to your rules, you stick to your rules, and you execute them, just like you're launching missiles. You gotta go through a procedure. Anyhow, this is telling me also a divergence. The other part is not plotted, but I can do it in my head because I've seen it before. I've seen it since 95. The lower price by sigma level, look at the reading there. So I'm willing to bet you we're going to go do this Monday. So probably most likely tomorrow night I'll go out. First I'll send a note to Jim Schmidt at Time and Digest declaring my position. Again, here you would see in the package that we post everything. For example, hold on. Here's our change of bias. And it's an email that went out exactly at the time we went out to him and you guys. I'll send a copy to you guys so those are members, and then goes here. So everything we do is recorded, and the ones with the golden rod, this background, that's very important. Just like a dashboard in an aircraft in emergency. This is what you want to read. Some people don't want to go through my charts and analysis, and for each week, it's available to them. Okay, but they want to say, hey, okay, what's my actionable item? These are actionable items. And look what we do. We put the charts up. We'll give you a target. Look at timestamps. Okay, we put the charts up on Tuesday. Yeah, and then a few minutes later, after that, we give our targets. Look at what targets were. To call those out, and we give you a spread on it. This is a put spread. You get a hold as a put spread, both legs. We'll tell you what the prices are. Then we give you levels to think about. This is a support and resistance level. You're going to hold through for the week. So you know what you gotta plan ahead what's coming down the pike. That's how you trade well. That's how you win. That's how you're alpha male. You go and say, hey, this is my plan. This is what I'm going to do. That's what I'm waiting. If it doesn't, you stop. You know, there's your tolerance. Here's a 5% playroom, and then I'm out. You don't wait for bad news. You move ahead, and out of the path you're in ahead of the bad news. Then we give you a launch command. Okay, this is Captain Tico. My dog is in charge of that. If you guys don't know Captain Tico, then well, maybe you should look him up on what do you call it, on Twitter. Actually, now it's Vice Admiral Tico. He's in charge of launch command, and somewhere in here we have an email for that. Hold on, I'll look that up while we're talking. One second. Launch command. And so, all right. So that goes out and tells you, okay, this is the trade we gave you. When you didn't say pull the trigger, we actually spoon feed you. We come back and say, go in now. It was at 8 minutes before 3 p.m. And then we followed. Then we're in. Okay. Then this was it. It says get ready to exit below 32.90. Why? Because that was 80% of trade. Some people get out. They just take one trade. But we do 80-20. We take 80 out, then move the stop to the current price so we can't lose, and then make a runner out of it. Well, this one was a huge runner. So if you saw this week. And so here's the 80%, and this is the other 20%. I'm sorry, this is the other one. This is the secondary target because this is primary target. Okay, very close. We gave it all that. That was the email, and that's the time to stop. We gave you another one email saying cover, 2 minutes into open, and welcome my America. Yeah, this is what I did. And look what we did. Went into $1.39, and we took out $2.95. 4 days, not too shabby. And this is as depth. You can put it up. And then that night we covered. That night we said done. We're flat. All right? Now, okay, let's get back here to charts again. So that's what I'm looking for on SP2. Now, another chart of interest to you guys would be, which what I look at, that's available is this one. You can get it on stock charts. Okay, and this is what's in there. This is the percent of S&P 500 stocks. They're above 200-day moving average. Okay, and I'm asking, what are we doing up here at 87%? Hello? When was the last time we were up here? None. It just usually about 3 years. You know, I usually go back 3 years, 2 years. We haven't had that. This was a very, very unusual high. And when it gets to, it's a rubber band. It's a stretch too far. So when it gets that far, it's what do you call it? It's a time to go. Okay, so guys, here's a launch command I was promising you. There's a launch command. You get email from us. Here's Captain Tico, recently promoted to Vice Admiral on the what we call it recess appointment because Moscow Mitch was too busy and Trump. He's a Trump kid. Tico's a Trump kid. Voted for him. I'm not a Republican, but I'm not a Trump kid. But he voted for him and from Alabama, of course. So he sends the execute command out and you execute. So he gives you the setup. You watch what's coming down the pike, and he says get out or get in. Okay, so yeah, he's in charge. It's a 9-pounder chihuahua, and it is amazing. His record in crude trading is amazing. If you watch him, you watch his trades on crude. Once he gave a $4 sell signal on crude, he was off by 3 cents. Remember, crude is 1,000 barrel per contract. So if you get a few of those right, you're retired. You're done. You move down here to Florida. Yeah. So God's waiting you. You move down here to Florida and you play bocce. All right. So having said that, let's not get too cute. That's what we do with market timing. That's how we run this baby. That's how we got our results. Let's see. The products. We have 2 modes there. Okay, obviously it's got 2 modes there. Timing and pro. Timing only gives you. Timing will give you this box, the upper side of the box, this part, okay? The option is the pro part. So because some of our people are money managers, they're not going to necessarily play the options, but they'll have a big boat. They want to use SPY as a hedge. And that's what we're trading SPY here too. But we time it on SPX. Why? Less noise. It's an index, it's not tradable. You don't want to do market timing based on something that's tradable because then it could be too much itself victim of fear and greed. Does that make sense? Because itself is tradable. Index is not. So this is the numbers. This is the market cap. Market cap over here. 500 names. I think is recomputed approximately every 6 seconds, maybe a little bit less now in this day and age. But so we time it against these levels. Where's my mouse? There we go. We time it against these levels, okay? But we trade SPY if they're doing cash holding. If it's a pro, you also get the chance to also suggest to take our suggested put or call spread. We've had I think it was 1 week ago or 2 weeks ago we were short still. And guess what? We dropped one day, and the put spread came back with a roar. I paid for it. So even though we may be short with the time and digest, and we're not, it's not going in our favor on an accounting basis, on a ranking basis. But we want to give you a put spread that will open your eyes. You'll see, boom, it comes in, and then we will alert you as it get close to exit time. Why? Because people demanded it. All of this is because people demanded it. I used to do this for free for our members only, because if you trade futures or if you trade even options, you need to have a sense of market timing. If you take in, here's the issue. Let me show you this. Let's go back to here. This is really, there's a lot of work has been done on this. You can read about it, Google it. Here's what it comes down to. Okay? Market goes down, we're going up. Market goes up, we're going up. This is like, forget this area. This is a month and a half. That was a disaster. We're going to see what happened. Market goes down, we go up. Market goes up, we go up. You see what that difference builds in your portfolio? It's huge. So if you have a strategic timing model that has withstand many, many, many markets, and it's not necessarily one program. It's, as you see, it's a blend of. It's like you can't take the cockpit of 747 away. Nobody's gonna fly it. You need the pilot in there. You need the captain in there. So we're there to interpret it. There's a lot of detail there. All of that goes in. Boom, 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 boom. And then we give you an actionable item. You go do the following. Here's our bias, do the following. Da, da, da. And then, and how do we keep track of it? We are simple. We do have, we have it on the cloud. We keep it file that keeps track of all of that. This is a TD performance, Time and Digest. Time and Digest has been in business, I don't know, about 50 years. They've ranked me since 2003. First year I was 11th. They don't rank you first year. They just see how you are, because you're not playing any game. In this model, we changed 2 or 3 items in our indicators, and we said so. There's a early January 2015 webinar that I said we're going to print a deck of cards because the Time and Digest is about. Let me see. Time and Digest. Hold on. There we go. Let me get one of it. Hotline issue. Okay. Well, can't open it or send it to you guys. Okay, because they sell it. But Time and Digest. There you go. It's a. They've been around in 40 years. Father and son in Greenwich, Connecticut, and they're not on my list or anybody's list, or nobody's their favorite. They just rank about 100 best names out there. So what we did was in that early part of January, we said, okay, guys, we're coming in. These changes are being done in December. But as of January, we're going to print a deck of cards. We're going to go after these 150 people, and we're going to take them out one by one. But give us about a year because the change in the program has been done. But then take that down. If you look at the chart, you'll see. By June, John Bollinger called me and said, I don't know what you're doing, man. You're kicking their ass because he watches this. Every month, have you known that? I said, I don't know. Where am I? Because you're ranked 1 for the first quarter, for the first half. So by the first 6 months, we were ranked 1 and we never get back. How do we do that? We keep track of it ourselves. As a double checker, what they keep track of it. And basically, you have the data coming in and your bias. Data is going to run and your bias is going to run. If you're going to have losses, you have gains. It builds up and goes. And there's a delta. We measure the delta. How far do we get? And we've gotten there too. I mean, that accident cost me definitely problems. Okay, this is this area right there. This is 12%. If this 12% wasn't there, you could see. We even got to 40% spread at one point. You could see the add 12 here. Yeah, 37. Compounded. Go to Morningstar. Nobody's done that. Nobody. Okay, no, not even close. And consistent. About 5% a year we beat the S&P by. Not the market. I mean, I'm saying the market. Not, yeah, we haven't been up 5%. No, this one friend of mine down the cigar bar, he's saying, Northern Trust did 29% for me last year. I said, what the F is that? We were up 30%. They actually lost 1% against the market. He goes, why is that? I said, SPX. Again, what do you thought? Berto Macchio, Vanguard. These are the guys who make this market. Your benchmark is SPX. If you return 1% below it, You're not all that hot, okay? There are a bunch of those guys at Morningstar. Come on, let me show you my charts, as Gecko said. Let me show you my charts. Once, if they do this, you talk to me. So, as a result, why am I saying that? Morgan Stanley, B of A, I don't know Goldman, no, I don't think so. Wells Fargo, these are independent offices, but many of their offices in this great nation follow us. They're part of PMT. But they basically do this part, the top part. They do the basics. They don't do the options because I think they don't want to touch that. The smaller guys, more active, the one self-directed, we have a lot. This package is about 500 people in it now. Okay. Well, let me stop here. I don't know what my timing is, David, and maybe if I can answer a few questions.
Hey, Fari, you still have a couple of minutes. If anyone has any questions.
Okay. Yes, please. How do I see the question? Are you going to read them out to me, or how does it work?
There's a little chat box. I can read them to you. So far, there are not any questions.
Am I that boring? Yeah. Is this not interesting, or am I that boring?
I personally loved it.
Remember, it's a very boring work. You're reading the tea leaves.
Yes.
Market is not going to show its hand. You have to figure out what that is, and you're not going to be always right. That's why we have stops. So that, the 80% of the time, maybe you're right, 70% you're right. For the 20 or 30%, you have stops. So, risk management is key. The other part is understand fear and greed. And remember, just like any index, it's mean reversion. So you want to buy or sell this extremes and do very little near the mean. So you cannot be reactionary. You have to be patient and strike when the iron is hot. Okay. If you guys want to contact me, go through David, please. But you have our website, and also on the PMT. I think recently one of my techies was saying that they put an open free preview. It basically holds back the last 4 issues. If you go there, it gives you a visitor status, and you could see, last 4 issues. I mean, it would be like if you go back, you see all of them. So, but if you're a paid member, obviously you're going to see all of them. But and go through David if you need any assistance with it. We're more than happy to comp you and give you a better price or whatever. I don't care. So.
Okay, Fari, there is one question. Can you make a prediction for next week? There is a question from Rainey Hancock.
Questions for Bernie?
For Rainey Hancock, yes.
Oh, Rainey. Geez, yeah, he's one of my guys. Hey, Rainey, how are you? Yeah, Rainey, my 80%, I can't say 100% about anything. Market has humbled all of us. My 80% guess or 85% guess is that we're going to at least rally up first couple of days. This was very strong and very painful for a lot of people. Not if you're on the short side. I mean, we did about 7% yesterday on the future side, but that's, because it was a continuous one-way move. Once you get to a one-way ticket, the day is easy. You just load them up and go. But we have, for the cases I explained, for the setups we have seen, most likely we're going to bounce. I don't think this is the bottom. Okay, I don't think we're there as the big tradable bottom that you mortgage the wife, the kids, the girlfriend, the dog. No, you can't do that. The other way. But I think when we cross -10, and sometimes I post that on Twitter, that's my main Twitter, at Hamzei Analytics. Then I will be in a more comfortable position to say, well, mortgage everything, don't forget the dog, mortgage the dog to buy now. Back up the boat, load it up, let's go. No, we're not there yet. But I think we'll have another little move up and then down again. But as I said early on back here, this area, that if we come in here, as a matter of fact, I know head of UBS for West Coast called me, saying he's a buddy of mine, of course, not because I know them, but he's a buddy of mine from years ago. I know nobody just joined UBS, and thank God he runs most of the West Coast. He says, Fari, what do you think? I said, dead cat bounce. He goes, what? I said, yeah, I think dead cat bounce. I don't think we're done here. And sure enough, Friday approved that, took all the lows out. So now this becomes a retest period, all right? So we should pull up, retest. If we fail, we go lower. If we don't, then that's what you want to buy. I look at what's called retest failure. I actually did a webinar on that. It's the issue of auction theory. It's a, you know, the buyer and seller are trying to find value. Okay, that's what auction theory teaches us. And what you do is you sit down, you sip on your coffee, or in case of Captain Tico or Vice Admiral Tico, he reminds you he likes Rumi. He reads Rumi and drinks fine Persian homebrew tea. He says, drink your tea and be patient. Why? You make more money if you're patient. You make less money if you just jump in. Take a look, see those retest failures look like. You're more calm. Your entries are not risk-free, but low risk. That is, if you use your volatility-based stops, you won't be in trouble. Why? The volatility will tell you how much your stop should be. Put it there moderately, but you're at the extreme point, so that it's a low risk. Remember, when things get bad, everybody's knees are shaking. That's why we safe trade. When everybody's upset, that's why we safe trade. When everything is hunky-dory, no, watch out. You got risk. You got risk. You got risk. Why? The people are too comfy. It's like, up here. Oh, honey, we don't think we need Hamzei Analytics anymore. We've done so well. Well, high tide raises all the boats. And now the garbage drops out fast. So, remember, I make more money on the downside. When things get really bad, we go through like crazy. Okay. On the top, everybody's a genius. Look, honey, how much we've made this month. Listen, really? Look at what the indices are at. Now, our issue was for a while. Why we're concentrating so few names? Advanced declines are telling us. Why is Amazon, Apple, all that? Well, a lot of times big boys gonna hide there because they don't trust or they're not comfortable. They're worried about small caps. Well, the small caps start dropping. So my hunch here right now, Rainey, is that we have not sold off enough, but we can't just sit there and pray for selling. We got to see what's called catalyst. I always said that. You heard me in the webinar. Look for the catalyst. What is the catalyst to take us there? So we have 200-day. Watch this level for transportation. Let's see if we're going to touch this one, and then we have to draw a draft and draw a new course. We begin to get one detrender, two detrender negative, right? We have two. One of them is almost to go. So we're in a little bit of downdraft. We should have a small
Fari.
bounce and then down. Yes, sir.
Yeah, so, sorry to cut you off. We're at the top of the hour now, so we need to go ahead and switch over. So thank you for your presentation. Thank you for being here.
Thank you, sir.
And
thanks for having me.
And yeah, great having you here. So thank you.